Most retirees believe the greatest danger to their savings is a market crash. But according to Jack Bogle, the real danger was often something far quieter, something slower, something that looked safe right up until the moment it quietly destroyed decades of financial progress. And what made this mistake so dangerous was not how complicated it was how normal it felt. Because millions of intelligent people were doing it at the exact same time. For decades, Americans were taught that successful investing meant activity, choosing the right stocks, moving money when markets became uncertain, watching financial news closely enough to react before everyone else. But Jack Bogle spent most of his life arguing the exact opposite, not because he disliked ambition, because he had studied what actually happened to real investors over long periods of time. And the historical record kept pointing to the same uncomfortable truth. The more emotional decisions people made with money, the worse their long-term outcomes usually became. This mattered even more after retirement, because when you are 30 years old, a financial mistake can often be repaired with time. At 65 or 70, time becomes more valuable than returns. That changes everything. And yet most retirees still approach investing with the same emotional habits they used during their working years. That is the quiet mistake Bogle warned about for decades, not fear itself, reacting to fear. The distinction sounds small. Historically, it has cost investors enormous amounts of wealth. To understand why, you have to go back to one of the most psychologically difficult moments in modern financial history. In 2008, the global financial system began to crack. Banks collapsed. Retirement accounts dropped with terrifying speed. News anchors spoke with the kind of nervous uncertainty most Americans had never seen before. For many retirees, it felt less like a correction and more like the possible end of financial stability itself. And during those months, millions of investors did what emotionally felt responsible. They sold, not because they were reckless, because they were afraid. Imagine spending 40 years building retirement savings, decades of early mornings, long commutes, careful budgeting, missed vacations, then suddenly watching years of progress disappear on a screen within months. Most people do not panic because they are irrational. They panic because the human brain is designed to avoid pain faster than it seeks long-term reward. And this is where many retirement plans quietly break apart, because markets eventually recover. But investors who sell during fear often lock losses into reality. Jack Bogle understood this deeply. He believed one of the greatest financial advantages was not intelligence. It was emotional stability. That idea sounds simple, but simplicity is often misunderstood as weakness, especially in finance. Wall Street has always rewarded complexity. Complicated products, constant predictions, unaggressive trading, endless movement. Bogle believed most of it distracted ordinary investors from what historically worked best over long periods of time. Patience, broad diversification, low costs. And remaining invested through uncertainty, not because uncertainty feels comfortable, because uncertainty is normal. This is the part many retirees never fully prepare for emotionally. The market does not reward calm conditions. It rewards surviving difficult ones. And what happened next after the 2008 crash surprised many experienced investors. The people who recovered most successfully were often not the smartest traders. They were the investors who avoided emotionally abandoning their long-term strategy. Some simply continued buying index funds consistently while markets were collapsing. Others stopped checking balances every day. Many did something psychologically difficult. Nothing. That restraint looked foolish in the moment. Historically, it proved incredibly valuable later. And Bogle kept repeating the same message during periods of panic. Nobody knows what markets will do next week. Very few people consistently predict crashes correctly, and even fewer successfully predict when fear is ending. That second part is what quietly damages retirement wealth, because investors who exit during fear eventually face another emotional decision. When do they get back in? Usually after prices have already recovered. Historically, many investors end up buying high after selling low, not because they lack intelligence, because fear changes behavior. This pattern repeated long before 2008. It appeared during the crash of 1987, during the dot-com collapse, during inflation panics of the 1970s, and during nearly every major period of financial uncertainty in modern American history. The details changed. Human behavior rarely did. That is why Bogle focused so heavily on systems instead of predictions. He believed retirement investing should remove as much emotional decision-making as possible, not because emotions are bad, because financial fear becomes strongest precisely when clear thinking matters most. And this is where many retirees accidentally increase risk while trying to reduce it. They begin chasing safety emotionally instead of structurally, suddenly moving everything to cash after markets fall, constantly changing strategies, reaching for someone who can predict what happens next. But historically, excessive reaction often creates its own form of danger, especially when inflation quietly reduces purchasing power over long periods of time. Bogle believed the solution was surprisingly unexciting. A simple diversified portfolio, low-cost index funds, reasonable expectations, and enough emotional discipline to stay consistent when headlines become frightening. That philosophy made many people uncomfortable because it lacked drama. No secret formula, no market timing system, no exciting predictions. Just patience repeated consistently for decades. And yet historically, simple, long-term investing strategies often outperform the behavior of more active investors, not because markets are easy, because human emotions are difficult. There is another part of this conversation retirees rarely hear discussed honestly. Financial stress itself has a cost, not just financially, psychologically. Constant fear about money changes how people sleep, how they think, how they experience retirement itself. Bogle believed investing should support life, not consume it. That idea feels increasingly rare today. Modern financial media profits from urgency. Every week feels like an emergency. Every headline sounds historic. Every market movement feels catastrophic. But long-term wealth has rarely been built through constant emotional reaction. More often it has been built quietly. Over time, through consistency, most people eventually become too impatient to maintain. And this is where the quiet retirement mistake becomes visible. Many investors spend decades building wealth successfully, then allow fear near retirement to slowly override the very principles that created that wealth in the first place, not overnight, quickly, gradually, emotionally. That is what Jack Bogle spent decades warning people about, not market crashes alone, human behavior during market crashes. The good news is that avoiding this mistake does not require predicting the future. It does not require superior intelligence, and it does not require watching financial news all day. Historically, many successful retirees followed remarkably simple principles. Keep costs low, stay diversified, avoid emotional decisions during panic, and allow time to do the heavy lifting. Simple does not mean easy, especially when fear becomes widespread. But history repeatedly suggests that calm investors often place themselves in stronger long-term positions than reactive ones. Jack Bogle spent much of his life repeating one idea that modern finance still struggles to accept. Wealth is rarely built through excitement. More often, it is built quietly, through patience, discipline, simplicity, and the ability to remain emotionally steady while the world around you becomes emotionally unstable.